Who owns offshore real estate in Dubai? Understanding who is buying tells about the market's stability, diversity, and long-term appeal. The direct outcome is that Dubai's real estate market is the most globally diverse in the world, with buyers from over 150 nationalities. This deep diversity is a massive strength, as it prevents the market from being overly reliant on any single economy. Here is the professional, detailed breakdown of the dominant offshore foreign investors, backed by up-to-date DLD market statistics for 2025. Dubai is one of the largest global hubs for offshore real estate ownership, offering foreign buyers a highly attractive and tax-efficient environment. The absence of personal income tax, capital gains tax, and estate tax, combined with favorable property regulations, has made the emirate a preferred destination for discrete wealth storage, international diversification, and cross-border asset protection. Despite Dubai joining the International Bank Information Sharing Framework, CRS, real estate ownership remains largely outside current global transparency rules, creating both investment opportunities and regulatory blind spots. Market size and magnitude. Dubai's real estate market was valued at USD 533 billion in 2020, of which USD 146 billion is owned by foreign nationals. Foreign-owned real estate accounts for at least 27% of Dubai's total real estate value, with the true total likely higher because 7% of ownership information could not be traced. The size of offshore real estate investments in Dubai is twice that of London, highlighting Dubai as the world's largest platform for international property wealth outside one's home country. Foreign ownership patterns. Foreign holdings are highly concentrated across a small number of countries. India, USD 30B, 20% of offshore real estate. United Kingdom, USD 15B, 10%. Pakistan, Saudi Arabia, Iran, Russia, Canada, and the US follow as major investor countries. Ownership is driven by geographical proximity, historic British Arab ties, access to tax-efficient asset protection and wealth mobility in premium districts such as Dubai Marina, Palm Jumeirah, and Burj Khalifa. Nearly 50% of ownership is foreign, with significantly higher participation from Russian elites. Real estate relative to GDP. Key risk signal. Some countries show exceptionally high Dubai real estate positions relative to their domestic GDP, suggesting that Dubai has become the primary offshore wealth storage venue for elites in unstable economies. Jordan, Afghanistan, Syria, Yemen, Sudan, Eritrea, Azerbaijan, Lebanon, and Tajikistan hold Dubai property values equivalent to 5 to 12% of their GDP. For many of these nations, elite capital flight, political instability, and sanctions avoidance are major explanatory drivers. Strategic insight. This confirms that Dubai is being used to store wealth that would otherwise be vulnerable to taxation, asset seizure, capital controls, or currency crises in home countries. Role of tax havens and citizenship programs in Dubai. Dubai property often intersects with offshore tax structuring. Tax haven entities, e.g., St. Kitts, BVI, Seychelles, Cyprus, Jersey, Puerto Rico, Gibraltar, own 7.9 billion US dollars in Dubai real estate. Properties held through these jurisdictions average 2 to 6 times the price of typical Dubai properties, indicating that luxury assets are disproportionately shielded through shell companies. Extremely high Dubai property to GDP ratios in some havens suggest that true beneficial owners are nationals from other countries using nominee structures. Compliance, transparency, and regulatory exposure. Evidence from Norway provides the clearest benchmark for compliance risk. Over 75% of Dubai real estate owned by Norwegian taxpayers was not reported for tax purposes. Property ownership probability rises sharply with wealth, including among the top 0.01%. This underreporting is happening despite automatic international financial information exchange because real estate ownership is not included in CRS reporting. Risk observation. Governments globally are effectively blind to foreign-owned real estate. This gap enables tax evasion, contributes to unrecorded wealth concentration, and complicates macroeconomic assessments of net foreign assets and debt sustainability. Why this matters for strategic decision making. Dubai is confirmed as a global wealth storage market, attracting liquid international capital and maintaining high real estate demand. Luxury real estate, development projects, wealth management, and elite services are positioned for sustained growth. Risks and challenges. Significant political and regulatory pressure is building internationally to extend CRS-style reporting to real estate assets. If transparency rules change, there could be short-term valuation volatility, forced disclosures for offshore investors, reduced speculative inflows, or more cautious financing structures. Management implications. To support corporate strategic planning, you should consider: 1. Market strategy. Strengthen footprint in luxury, serviced residences, and high security developments where offshore investment is highest. Target buyers from India, UK, Pakistan, Saudi Arabia, Iran, Russia, and Africa with structured advisory services. 2. Compliance and advisory. Expand cross-border tax advisory, beneficial ownership structuring, and regulatory risk consulting for international buyers. Position yourself as a trusted partner for transparent and compliant offshore acquisition processes, anticipating future regulation. 3. Risk monitoring. Monitor FATF grey list actions, CRS policy extensions, EU OECD real estate transparency initiatives. Any material shift in regulation could reshape foreign investor demand, transaction liquidity, and valuation models. Top 5 foreign investor nationalities in Dubai as of 2025. The Dubai Land Department, DLD, consistently reports high transaction volumes and values from non-residents, and the composition of the top buyers reflects global capital movements, stability, and growth opportunities. Why diversity is protection. Financial resilience is offered to the top investors who come from different continents, economies, and political systems. If one economy faces a downturn, like UK inflation, another is often surging, like wealth accumulation in India or China. This balanced capital flow creates a highly resilient market that doesn't suffer the dramatic crashes seen in less diverse markets. Different nationalities favor different asset classes. Indians and Chinese often favor off-plan projects for higher capital appreciation and flexible payment plans. British and Saudi investors typically target ready luxury villas and prime waterfront properties for lifestyle and immediate use. Emerging investor segments. There is fast-growing influx. Beyond the top 5, other nationalities are rapidly increasing their presence in the Dubai market, reflecting its true global appeal. European nationals from France, Germany, and Italy are seeing a noticeable increase, often focusing on high-end branded residences and taking advantage of residency visas. North American investors from the US and Canadian buyers are increasingly active, driven by superior rental yields, often 7 to 8% versus 3 to 4% in major North American cities, and the appeal of the tax-free regime. Pakistani and GCC investors remain consistent and strong players, attracted by proximity, cultural familiarity, and stable investment returns. Dubai isn't owned by any one nation. It's a giant, beautiful, competitive free-for-all. It's the place where the world's wealth comes to play, settle, and most importantly, grow. This competition for assets is precisely what helps fuel capital appreciation and liquidity, entering a market that the world's most sophisticated investors have already vetted, i.e. priceless.